What is up guys, welcome back to the channel. Russell Hardy from the Vitol Group suggests that global oil demand is set for a rebound between now and the end of the next year, with consumption expected to rise from current levels by as much as 8 million barrels per day by end of 2022. According to Hardy, currently the oil demand is somewhere 3.5 million barrels per day below the normal levels of 2019, when consumption was around 100 million barrels per day. Here we have the daily price chart for crude oil, and I have divided it into three main segments. After the April lows of 2020, when oil price managed to go below zero, it bounced back up quickly and we climbed to around $40 per barrel. But then we get this first big segment here, which was a 6-month period of consolidation. Then by the end of 2020 we got some good vaccine news and the demand started to moving back up. So here begins the second segment, which is a nice bull run. But by March of 2021 the price action started losing steam and we are currently consolidating just over $60 per barrel. So we are in this third segment right now. So if we believe that there is still room for the demand to ramp up, that means that there is another leg of upside available for the next year. So it may be a good idea to start nibbling on some oil stocks during this consolidation period. With that in mind, for a comparison today I have picked three large players from the oil industry. These are Exxon Mobil, ticker symbol XOM, Chevron, CVX, and ConocoPhillips, ticker COP. In order to make the comparison possible, we will be looking into 8 different factors: Analysts' price targets, forward price to earnings ratio, annual revenue growth, price to sales ratio, return on equity, last 4 quarterly earnings results, current ratio, and dividend yield. The best company under each factor will get a point, so it is possible to have from 0 to 8 points, and in the end the stock with the most points will be considered the winner of this comparison. I hope that the rules were clear, so let's begin. First factor we have are the analysts' price targets. As investors we want to check how far the current share price is away from the average target of analysts. If the current price is under the average target, we will consider the stock as undervalued, and in the end the company with share price is furthest away from the average target to the lower side gets a point for this factor. For Exxon we have 25 price targets of analysts. They range from the lows of $40 to the highs of $90 per share. The average is at $62.52 and the current share price is at $55.71. So there is around 12.2% room for the current price to reach the average target of analysts. For Chevron we have 26 price targets of analysts. They range from the lows of $100 to the highs of $152 per share. The average is at $119.74 and the current share price is at $101.96. So there is around 17.4% room for the current price to reach the average target of analysts. For ConocoPhillips we have 26 price targets of analysts. They range from the lows of $55 to the highs of $80 per share. The average is at $64.81 and the current share price is at $49.61. So there is around 30.6% room for the current price to reach the average target of analysts. Analysts' price targets are in the table, and with most room for growth, ConocoPhillips gets the first point. Second factor is the forward price to earnings ratio. It is calculated by taking the current share price and dividing it by the estimated future earnings per share. This is the standard price to earnings calculation, with the difference that earnings here are predicted by analysts. So in the end, the stock with the lowest forward price to earnings ratio gets a point for this factor. For Exxon Mobil, the forward price to earnings is at 13.75. Forward price to earnings for Chevron is at 16.21, and ConocoPhillips has a forward price to earnings of 15.85. Forward price to earnings ratios are in the table, and with the lowest value, Exxon Mobil gets the first point. Third factor is the annual revenue growth. As investors, we want to check if the revenues of a company are on a steady increase. We will take a look into the 4 most recent years and compare them one by one. If revenue was on the increase from one year to the next, we will consider it as a +1, and if it was on the decrease, it will be a +0. Then we sum the results up to a minimum of 0 and a maximum of 3, and in the end, the stock with the highest sum gets a point for this factor. We have annual revenues for Exxon, and going into 2018 there was an increase to $281 billion. Then going into 2019 we had a decrease to $255 billion, and going into 2020 there was another decrease to $179 billion. So with one increase and two decreases in annual revenues we have a sum of 1. Revenues for Chevron. And going into 2018, there was an increase to $158 billion US. Then into 2019, we had a decrease to $139 billion. And going into 2020, there was another decrease to $94 billion. So with one increase and two decreases in annual revenues, we again have a sum of 1. Revenues for ConocoPhillips. And going into 2018, there was an increase to $37 billion US. Then into 2019, we had a decrease to $33 billion. And going into 2020, there was another decrease to $19 billion. So with one increase and two decreases in annual revenues, we again have a sum of 1. Results for the annual revenue growth factor are in the table. And since each company has a sum of 1, no one is assigned a point for this factor. Fourth factor is the price to sales ratio. It is calculated by taking the market cap and dividing it by the trailing 12 months worth of sales. The formula suggests to be looking for a company with a low market cap and with a high result in sales. So in the end, the stock with the lowest price to sales ratio gets a point for this factor. For Exxon Mobil, the price to sales is at 1.31. Price to sales for Chevron is at 2.08. And ConocoPhillips has a price to sales of 3.49. Price to sales ratios are in the table, and with the lowest value, Exxon Mobil gets another point. Fifth factor is return on equity. It is calculated by taking the net income and dividing it by the shareholders' equity. A high ROE shows that the company is well managed and that money from investors are efficiently handled. So in the end, the stock with the highest return on equity percentage gets a point for this factor. Exxon has a return on equity of minus 12.81%. Return on equity for Chevron is at minus 4%. And ConocoPhillips has a return on equity of minus 8.18%. Return on equity percentages are in the table, and with the highest value, Chevron gets the first point. Sixth factor is the last 4 quarterly earnings results. When a company reports earnings, they are compared to expectations of analysts. So earnings can either beat expectations, meet them, or miss them. We will consider that beating expectations is a +1, meeting +0.5, and missing 0. Then we sum the results up to a minimum of 0 and a maximum of 4. And in the end, the stock with the highest sum gets a point for this factor. Quarterly earnings for Exxon Mobil, and Q1 of 2020 beat expectations, Q2 missed, Q3 beat expectations, and Q4 beat. So with 3 beats and 1 miss in earnings, we have a sum of 3. Earnings for Chevron, and Q1 of 2020 beat expectations, Q2 missed, Q3 beat expectations, and Q4 missed. So with 2 beats and 2 misses in earnings, we have a sum of 2. Quarterly earnings for ConocoPhillips, and Q1 of 2020 beat expectations, Q2 missed, Q3 beat expectations, and Q4 beat. So with 3 beats and 1 miss in earnings, we have a sum of 3. Results for the last 4 quarterly earnings factor are in the table, and with sums of 3, both Exxon and ConocoPhillips each gets a point. Seventh factor is the current ratio. It is calculated by taking the current assets and dividing them by the current liabilities. As investors, we want to check if the company is able to cover its debts with assets, but also if they are actually being leveraged. So in the end, the stock with the highest current ratio between 1.5 and 3 gets a point for this factor. Exxon has a current ratio of 0.8. Current ratio for Chevron is at 1.18, and ConocoPhillips has a current ratio of 2.25. Current ratios are in the table, and with the highest value between 1.5 and 3, ConocoPhillips gets another point. The last factor we have is the dividend yield. It is calculated by taking the annual dividend per share and dividing it by the share price. A high dividend yield may suggest that profits are shared with shareholders, and that is a great passive income source that we as investors are looking for. So in the end, the stock with the highest dividend yield gets a point for this factor. Exxon Mobil is paying an annual dividend of $3.48 per share, which is a dividend yield of 6.29%. For Chevron, the annual dividend is $5.16 per share, which is a yield of 5.09%. And for ConocoPhillips, the annual dividend is at $1.72 per share, which is a yield of 3.44%. Dividend yields are in the table, and with the largest percentage, Exxon Mobil gets another point. We can calculate the results, so Exxon has 4 points, Chevron 1, and ConocoPhillips 3. This means that with a sum of 4, Exxon Mobil is considered the winner of this comparison. And that was it. If you got value or new ideas, then make sure to push that thumbs up, it helps the channel a lot. Now there is a question for you: which oil stocks are you holding? Share your best picks in a comment below. If you're interested to know exactly when I buy or sell in stock, then consider the options on Patreon. This week we already did a comparison between between several satellite communications companies, and we also have 34 weeks worth of investing with the Revolut stock portfolio. If you are interested in any of these, then click on the video currently on the screen. And that was it from my side, thank you for watching, and I will be seeing y'all in the next one.